computation of VAR margin requires the following definitions. 1. Security sigma. It means volatility of the security computed as at the end of the previous trading day. So, it is basically the volatility that has taken place, that is the percentage of move a stock has taken place the previous day at the end of the trading day of the previous transactions. The computation uses exponential weighted moving average method applied to daily returns of the same as if it is in the derivatives market. Now, how do we arrive at the second point, that is security VAR, value at risk? We have seen how to arrive at the volatility of the security in security sigma. Now, we are seeing what is the value at risk for such particular security based on this security sigma. It is arrived at higher the value of 7.5% of this security sigma or 3.5 times the security sigma, whichever is higher. That means, if the volatility is, let us say 10%, or the volatility or the movement of the stock is 10%, then we arrive at 30% as the actual security sigma or security VAR for that particular security. So, we use this particular methodology for calculating what should be the margin structure for that particular security. Now, we have seen what is security sigma, then we are seeing what is security VAR. Based on security sigma, we have arrived at what should be the security value at risk margin. Now, we are seeing index sigma, that is the volatility for the index itself. It means the daily volatility of the market index. The market indexes are S&P CNX Nifty, which is for NSE, or BSE Sensex, computed as at the end of the previous trading day. The computation uses exponentially weighted moving average method applied to the daily returns in the same manner as in the derivatives market. Now, based on this index sigma, we can calculate what is the index VAR, that is value at risk margin. It means it uses the higher of 5% of this index sigma, that is the volatility as of previous day for the index, or it uses 5% of this particular index sigma. Out of these two categories, whichever VAR, index VAR works out to be higher, that will be considered for the purpose of margining or margins that the clients or the trading members have to make the payment for the purpose of placing the orders in such securities. The higher of the Sensex VAR or Nifty VAR would be used for this particular purpose of index VAR calculation. Now, we can see a beautiful table where the VAR margins for different groups of securities, how they are calculated. We have already seen there are 3 groups of securities. So, all the securities can be put under these 3 groups only. Now, if a security is categorized under liquid securities under group 1, then what is the 1-day VAR, that is what is the 1-day value at risk calculation value arrived at using security VAR. Now, what is the scaling factor for this illiquidity of this particular security? It is taken as 1. Now, what is the VAR margin that has to be imposed on such security which falls under liquid security group 1 category? It is security VAR, that is how the security's volatility as of previous day will be used for the purpose of VAR calculation of such security margin. Less liquid security group 2. How do we calculate the VAR margin for this particular securities in this particular second group? Higher of security VAR and 3 times index VAR. We take these two and find which is the higher one. That means we take security VAR of that security in that particular group. We also take index VAR, the Nifty VAR or Sensex value at risk. We take these two things. Now, what we do with the index VAR? We take 3 times of the index VAR and value and find this value and compare it with the security VAR. And the scaling factor used here is square root of 3, that is 1.73. Now, based on this information, what is the VAR margin that is imposed on securities which are under second group? It is taken as higher of 1.73 times security VAR and 5.2 times index VAR. So, we take 1.73 of security VAR, we also calculate 5 times index VAR, then we compare both, whichever is higher, that percentage, that value will be used for the purpose of calculation of VAR margin. Now, coming to illiquid securities, that is third group category of securities. In this, the 1 day value at risk is taken as 5 times index VAR, value at risk. We have already seen how index VAR is calculated. It is calculated as the previous day ending volatility. So, here to arrive at the daily VAR for this particular security which is under third group, we take 5 times the index VAR as the base. Then what is the scaling factor used for calculating VAR margin for this particular security? It is 1.73 or square root of 3. Now, the VAR margin for such securities under group 3 is 8.66 times the index VAR. So, any security which falls under third group, for that group we take VAR margin as 8.66 times the index VAR as the basis for imposing the margin structure for the securities. Now, all these securities are accordingly classified into 3 groups and then accordingly the margins are being imposed. Now, VAR margin rate for a security constitutes the following: value at risk based margin, which is arrived at based on the methods which we have stated right now. The index VAR for this purpose would be the higher of the daily index VAR based on Nifty or Sensex. The index VAR would be subject to a minimum of 5%. For the security specific margin, NSE/CL may stipulate security specific margins for the securities from time to time. So, certain securities NSE/CL can accordingly decide what can be the margins they want to specify for such securities. Now, how is this VAR? We have calculated what sort of VAR percentage we have to use for the margining of these securities depending upon their security sigmas, security VARs or the group in under which they are. Now, this VAR margin rate is computed as mentioned above, which will be charged on the net outstanding position. That means, we have arrived what is the percentage of VAR margin we have to impose on the transaction which we are going to do, but what should be the value on which this VAR margin has to be calculated or imposed? It is based on the net outstanding position, that is buy value minus sell value of the respective clients on the respective securities across all open settlements. So, they compile all the transactions of a particular client, then they take the buy value transaction, sell value transactions, and the balance on that they will calculate this VAR margin. There would be no netting of these positions across different settlements. That means, certain transactions which are done today, for those transactions they take the buy value and the sell value, they take the difference of it, on that they will calculate the VAR margin as discussed depending upon what category this security falls into or which group it falls into, but they will never try to combine this open position value for computation of VR with next day's or other settlement transactions value. So, they are done for one particular settlement for one particular period only. So, for individual days or individual periods individually, they are netted for the calculation of VR margin, and accordingly that margin is imposed on those transactions for that specific period only. Fine. There would be no netting of positions across different settlements. The net position at a client level for a member are arrived at this particular situation, and thereafter it is grossed across all the clients, including the proprietary position, to arrive at the gross open position of that particular trading member. So, they take for each client what is the open position for which the VAR margin has to be imposed. For each and every client, it is separately taken for that particular specific transaction period, and on that they will calculate the actual VAR margin for that particular period. This is how the VAR calculation is done in the particular trading member situation. For example, in case of a member, if client A has a buy position of 1000 in a security and client B has a sell position of 1000 in the same security, the net position of this particular member who is having these two clients of this security would be taken as 2000. The buy position of client A and sell position of client B in the same security would not be netted. It would be summed up to arrive at the member's open position for the purpose of margin calculation. So, a client A has bought 1000 of same security, client B has sold 1000 securities of same security. Both put together, the open position is taken as 2000, but it is not said as 0 because one guy bought 1000, other guy sold 1000 of the same security. That does not mean the open position is 0. It is not that way. The open position of A 1000, the sell open position of B 1000, total put together 2000 becomes the open position of this particular trading member. This will help to arrive and calculate the VAR margin. Now, we have seen how the VAR margin is arrived using security VAR, using index VAR for different groups. Now, we have seen how the security VAR is imposed on the transactions which are done by netting the gross position of individual clients on that particular trading period. Now, how this VAR is collected? The collection of VAR margin. The VAR margin is collected on an upfront basis by adjusting against the total liquid assets of that particular member at the time of trade. So, once this VAR margin is calculated, that amount is collected from the liquid assets or liquid amounts that are present in the trading member's account. The VAR margin is collected on the gross open position of the member, as we have already dealt. The gross open position for this purpose would mean the gross of all net positions across all the clients of a member, including its proprietary position. For this purpose, there would be no netting of positions across different settlements. This is an important point. That means, whatever the gross net positions of different clients and their proprietary trades are taken for that particular period, only for that particular period the VAR is calculated and collected depending on or based on the liquid assets or liquid amount that is available in the trading member's account. This is separately, independently handled, and for the next settlement day again it is repeated in the same manner, and again the VAR margin that is imposed or that has to be paid by the trading member will be again collected from the liquid amount that is available in the trading member's account for that particular settlement only. So, that means for each settlement, each open position is calculated, each VAR margin is calculated, and for each settlement, each VAR margin, the amount is collected separately. Now, let us come to MTM, mark to market. This is the second category of calculating the margins. We have seen how VAR is calculated and introduced or imposed at the time of placing the orders of different securities. Now, the second category of margins is called mark to market margin. Mark to market loss is calculated by marking each transaction in security to the closing price of the security at the end of the trading day. In case security has not been traded on that particular day, the latest available closing price at NSE is to be considered as the closing price for the imposition of the mark to market loss calculation. In case the net outstanding position in any security is nil, the difference between the buy and sell values is considered as notional loss for the purpose of calculating the mark to market margin that is payable by the trading member. The mark to market margin is collected from the member before the start of the trading on the next day. That means any loss or notional loss that arises in the position of that particular trading member after the closing of the market at the closing price of that particular security or settlement, the difference of that amount, that is the net loss, the notional loss, has to be paid by the trading member by next day morning, which is considered as mark to market loss or mark to market amount or margin. The MTM margin is collected, adjusted from against cash, cash equivalent, component of the liquid net worth deposited with the exchange. So, whatever notional loss that is calculated based on the closing price of the security, that amount which is the notional loss on the positions of the trading member will be collected from the cash or cash equivalent deposits which are available at the exchange on behalf of the trading member. Fine. The MTM margin is collected on the gross open position of the member. The gross open position again means the gross of all net positions of all his clients of a member, including his proprietary positions also. That means whatever the mark to market losses that are arising on the positions of his clients, on the position of his own proprietary accounts, all those are put together becomes the gross net open position for mark to market calculation, and such amount is used from the cash and cash equivalents which are deposited with the exchange by this particular trading member. Fine. One important thing here is there would be no netting off of the positions and set off against the MTM profits across two different rolling settlements. Example, for the trading day and the next trading day's profits and losses, they both cannot be netted. That means if the trading member, the total notional loss today, let us say is 2 lakhs, and on the next day there is a profit of 1 lakh on the total transaction on the next day by the trading member or his clients, that means the actual loss is 1 lakh, but such transactions or such setting off is not done. The trading member has to pay 2 lakhs for the first trading session for which there is an open position and is a mark to market loss is there. Fine, that 2 lakhs is paid by next day morning. Next day 1 lakh profit is arrived, so that 1 lakh profit will be received by the trading member, but the previous day's loss of 2 lakhs will not be adjusted against 1 lakh profit which is done the next day. This is a very important aspect. That means all the mark to market loss or calculations are done on settlement to settlement basis only. In case of trade for trade settlements, this is one of the category. Each trade is marked to market based on the closing price of that particular security. The MTM margin so collected is released on completion of pay in of that particular settlement. Now, we can see one particular example where we can understand how to arrive at MTM, mark to market.